Welcome to the June 30th, 2025 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. Halfway point in the year, and what a half it's been. This week, the big news, S&P 500 Blue Chip Index hits an all-time new high with distance, actually up 5% for the year. How we got there is a dramatic story. Let's go to the first part of it. We go to new highs. The Dow actually hit 45,000. That was optimism about the new administration. Then the new administration started talking about tariffs, and they were all confusing. And they started implementing tariffs, and tariffs were going to cause inflation. We're going to cover that story too. Tariffs are going to cause economic disruption. Well, let's see what actually happened. You did have an official bear market in the first half of 2025, which makes it kind of shocking. You're up 5% for half a year. That's 10% annualized. Wow. Well, what happened? Okay, big old sell-off. The Dow actually hit 36,600 at the low. The S&P was down over 20%. Tech stocks got smashed up by about 25%. Whoa, and it was going to be bad. Now, tariffs everywhere, recession, stagflation, and the headlines were bad. Some of that politically driven. But we started just looking at the data. Data wasn't so bad. We were able to add for the portfolios high dividend blue chip companies during this turbulence. And that's obviously turned out well. The portfolios are at new highs, well above November 30th, which was the high last year. Wow, that's good news. But by looking at the data, as we do here every week, I'm Spencer McGowan, President, McGowanGroup Wealth Management, and your financial weatherman in our weekly fast-paced global tours of the financial markets. Before all this started, we did a study on 2018, the last time there were a whole bunch of tariffs by Orange Man Bad Trump. I'm being sarcastic, but anyway, he put on a lot of tariffs then, and the Dow would go down 1,000, and I'd get media calls to do interviews, because everything was going to be bad. GDP was just fine, and inflation went from 2.9 to 1.5, and you'd know that if you were a subscriber. So it's good to be a subscriber and get your kids on board so they won't be broke and asking you for money. Anyway, earnings came in pretty good, about 12% over last year during the first quarter. Second quarter, we don't have them yet, but it looks like it'll be about the same, and then the earnings start to rise dramatically. Wow, and so you're starting to anticipate that. But it was shockingly positive. One of the most recent events that corresponded to the new highs, this is the Tel Aviv Stock Exchange. So these are the Israeli companies. You can see right here the low of October 7th, 2023. Obviously, a huge threat with a seven-front war against them. The elimination of Iran's nuclear facilities is good news, obviously, for Israel and the rest of the Middle East, but that setback for the Iranians changes the picture dramatically for the world, because Middle East escalation always corresponded to oil up and, of course, stocks down, because we were entering potentially a larger conflict. And you can see this index has doubled from its lows of October 7th, and it sets, obviously, the anticipation of a bright future, we hope. All right, here was the other thing that happened. Tariffs raise prices, causing inflation. Is that premise valid? Not based upon what we showed you about 2018. In fact, we hit a 4-year low last month in inflation. It ticked up to about where it was the month before. The headlines are saying, oh, inflation rose in the month of May. Well, you could see it's bouncing along a 4-year low on personal consumption expenditures inflation. That was shocking. It was shocking to me, shocking to a lot of investors, and the reversal of that premise says maybe not. Now there's more tariffs to come, and it could be bad. GDP. Estimates for GDP were about 1% in April, right? 1%. Even the Atlanta Fed said 1%. Tariffs make it harder to get stuff. There's disruption, less economic activity. You got all those Chinese-made rubber duckies and Buzz Lightyear dolls not going to make it to Walmart, and that doesn't add to GDP. So you have disruption, supply chain disruption. Instead, the numbers we got were different. The estimates from the Atlanta Fed, they gather the data every week, by the way, which is really important, and they calculate what is national GDP right now for this quarter. It went all the way above 4% briefly. This week they did adjust it to 2.9. But what's that direction? Wow, that's pretty positive economic growth. 2.9 versus 2.1, the 20-year average. That is a wow for most investors. And here we've got interest rates. The 10-year Treasury actually hit 4.6, now down below 4.3, hit 4.25 this week. What does that mean? Interest rates for borrowing have come down, and the Federal Reserve has their next announcement July 30th. Now, if Trump would quit calling Jerome Powell names, he might actually cut the rates. Because if inflation's 2.3 and the Fed funds rate, T-bills, and the 10-year Treasury correspondingly are 4.3, well, that's his Fed funds rate. He's about 2% too high by the standards set by the Federal Reserve activity in the past. That's why Trump called him Mr. Too Late. Then he called him a fool. Then he called him a total loser. And this week he called him an average mentally person. Then he called him low IQ. So maybe if Trump will quit insulting Jerome Powell, he'll get around to his day job. And the rates actually on the Fed funds, the overnight bank lending rate, should be about 1% lower, maybe 2% lower than where they are based on inflation. And that path, combined with earnings estimates in the double digits growth rate for 26 and 27, is part of the reason you're seeing new highs. We adjusted the portfolios during that meltdown using tactical safety, and we will keep you posted on the energy markets next week, where oil had gone from 77 to 65. Next episode, we're going to cover the pipeline strategy, better than exploration and production, in my opinion. We'll cover why next for our portfolios. I'm Spencer McGowan, President, McGowanGroup Wealth Management. Thank you for tuning in. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.